Hello everyone, welcome back to another video. In this video, I will teach you a very profitable Heiken Ashi trading strategy to simplify your trading entries and exits, so you will know exactly when it's time to enter or exit your trade without any complicated analysis, since the Heiken Ashi chart is much easier than the traditional candlestick chart. But before we go any further, make sure to like this video and subscribe to the channel if you didn't yet. Heiken Ashi is Japanese language which means average bars. It is used to chart the market like the traditional candlestick bars. However, it looks very different. The Heiken Ashi technique averages price data to create a Japanese candlestick chart that filters out market noise. Heiken Ashi charts share some characteristics with standard candlestick charts. That being said, Heiken Ashi charts can be applied to the same time values as regular candlestick charts, making them useful as part of a scalping, day or position trading strategy. But they differ based on the values used to create each candle. Instead of using the open, high, low, and close like standard candlestick charts, the Heiken Ashi technique uses a modified formula based on 2-period averages. This gives the chart a smoother appearance, making it easier to spot trends and reversals, but also obscures gaps and some price data. Let's take a look at these charts. On the left we have the first price chart that is using traditional candlestick bars. On the right we have the same price chart using Heiken Ashi bars. As you can see that with the Heiken Ashi bars, it's much more smoother. And the reason why it happens is that the Heiken Ashi chart uses a rather complex calculation method to derive the formation of the bars. Heiken Ashi uses one period to create the first Heiken Ashi candle, and then the open is equal open of previous bar plus close of previous bar divided by 2. Close is equal open plus close plus high plus low of current bar divided by 4. High is equal the maximum value from the high, open, or close of the current period. Low is equal the minimum value from the low, open, or close of the current period. Thankfully, you do not need to memorize this formula to use this chart. Your trading platform will automatically do everything for you. The most important is to know how the Heiken Ashi works and how it is used. The Heiken Ashi chart is used to identify a given trend more easily. Green candles with no lower shadows are used to signal a strong uptrend, while filled red candles with no upper shadow are used to identify a strong downtrend. Reversal candlesticks using the Heiken Ashi technique are similar to traditional candlestick reversal patterns. They have small bodies and long upper and lower shadows. There are no gaps on a Heiken Ashi chart as the current candle is calculated using information from the previous candle. Because the Heiken Ashi technique smooths price information over 2 periods, it makes trends, price patterns, and reversal points easier to spot. Candles on a traditional candlestick chart frequently change from up to down, which can make them difficult to interpret. Heiken Ashi charts typically have more consecutive colored candles, helping traders to identify past price movements easily. And also the Heiken Ashi technique reduces false trading signals to help traders avoid placing trades during these times. Another big difference that you must know is that the traditional candlestick bars have many different types of candlestick patterns. You have the doji, gravestone doji, the dragonfly doji, pin bars, you have the engulfing candlesticks patterns, and so on. There are literally tons and tons of candlestick patterns with the traditional candlestick chart. And most of them are not reliable. But the Heiken Ashi charts have only 3 main types of bars: bullish bars, indecision bars, bearish bars. First, bullish Heiken Ashi bars. With the bullish Heiken Ashi bars, you will notice that there's only a wick at the top of the bar, but there's no wick at the bottom. As long as this is an up bar with no wick at the bottom, we consider this a bullish signal. Second, indecision Heiken Ashi bars. The indecision Heiken Ashi bars have wicks at both top and bottom. So regardless of whether the bar color is bullish or bearish, as long as there are wicks on both sides, we will consider this an indecision Heiken Ashi bar. And the third is the bearish Heiken Ashi bars. They have a wick at the bottom but not wick at the top. As long as this is a down bar with no wick at the top, we will consider this a bearish signal. Heiken Ashi candlestick signals. There are 3 primary signals that identify trends, buying and selling opportunities. 1. Green candles with no lower shadows indicate a strong uptrend. This is a buy signal. An exit signal for short positions. 2. Candles with a small body surrounded by upper and lower shadows indicate a trend change or indecision of the market. This should be your exit signal, or you can wait the decision of the market in next candle. 3. Red candles with no higher shadows identify a strong downtrend. This is you sell signal and exit signal for long positions. These signals may make locating trends or trading opportunities easier than with traditional candlesticks. The trends are not interrupted by false signals as often and are thus more easily spotted. Trading strategy. Now that you know what are Heiken Ashi bars and you know the 3 different types of bars and signals, let's build a trading strategy. This trading strategy incorporates Heiken Ashi charts as one of its core components. 20 and 50 exponential moving average. These 2 moving averages will work as a dynamic support and resistant. And the reason why we chose the 20 and 50 period is that they're one of the most used moving average by big players in this market. By rules. So here are the rules for entering and managing a long position. Step number 1. Spot the trend of the market with higher time frame. The higher time frame must be in an uptrend. What this means is that the high time frame has to be making higher highs and higher lows. If you're trading the 5 minutes or 15 minutes chart, then the higher time frame would be the 1 hour chart. If you're trading the 1 hour chart, then the higher time frame would be the 4 hour chart. If you're trading the 4 hour chart, then the higher time frame would be the daily chart. You can also trade with time frame lower than the 15 minutes chart, but I do not recommend because of commissions and spread will eat away a significant amount of your edge at lower time frames. Step number 2. The 20 exponential moving average must be above the 50 exponential moving average in higher time frame. Step number 3. Go to lower time frame you're trading on. The 20 exponential moving average must also be above the 50 exponential moving average. Step number 4. Wait when the price bounces off either of the exponential moving averages and buy on the first bullish Heiken Ashi bar. Step number 5. Place stop loss below the low of the current swing low. Step number 6. Take profit when a bearish Heiken Ashi bar is formed or when indecision bar is formed followed by a bearish Heiken Ashi bar. Sell rules. Sell rules are the opposite of buying rules, simply follow the same steps. As you could see, the Heiken Ashi charts can be useful as part of a scalping, DayTrading or position trading strategy. Thanks for watching. In case you have any questions, don't hesitate to ask in the comments. Please don't forget to like the video and subscribe to the channel. See you in the next video.